Hi, and welcome to our quarterly update. My name is Brad Kelly, and joining me today is Darren Pladsen, Director of Investment Strategy, and Andrew McDermott, Financial Advisor from our Spokane office. So guys, let's jump right into it. 2019, quite a year in the markets. Just general thoughts before we get into the material today.
You know, if we could do this for 10 straight years, I think a lot of people would retire early. No, obviously great year. I was just looking at returns up and down from obviously the U.S. stock market, international stock market, emerging markets, the fixed income bond markets. Everything was really, really good. What's interesting to me is 2018. We remember fourth quarter, and the fourth quarter was the demise to all of 2018, and that it was very similar, where correlations were extremely high, and things worked kind of together. So all in all, a great year, and even from an economic standpoint too.
Yeah, I mean, you know, we look at the markets last year. The S&P was up 31%, just over 31%. What was unusual last year, maybe not quite unusual, but you know, we had both equities and fixed income that provided a real positive rate of return. I mean, what contributed to that, do you think, on the fixed income side?
Yeah, well, just generally speaking, we talked a lot about the 10-year treasury. I do anyway with clients. Andrew and I were just having this conversation this morning. Start of 2019, the 10-year started at 2.6-ish and ended the year about 1.8. In between, it went from 2.6 to 1.6. and it's kind of an inverse relationship. People don't really understand, but when bond yields drop, it means the price of the bond actually rises. So we got price appreciation along with obviously the dividend or the yield on the market or the bonds. And so yeah, just a great year. Do you have anything to add there, Andrew?
Well, I think it's odd to see the bond funds have the type of returns that we saw this year, and we were talking a little bit about this right before, as you mentioned, when you have Germany and other European countries with negative yields. Well, okay, we have more people buying U.S. Treasuries, and that's gonna create more, change the supply-demand curve. You know, and I think to both of your points, I mean, I don't think anyone expected 2019 to do what it did, one high after another high. There are a lot of good investment advisors in 2019.
Right, exactly. And so, I mean, how do you feel, or what are you hearing from clients right now after a year like we've had as we head into the new year? I mean, are you getting a sense that clients are getting overly bullish? Are they still very cautious? What is your sense there?
I think all in all, people are still pretty cautious, especially in the central states, it seems like. But I've felt that for probably 3 years, which, you know, might be a good thing, might not be a bad thing. I think, especially this year, you know, as we're filming this yesterday, the coronavirus hit the market really, really hard. Little shocks to the system seem to be winning right now. And as I say this, also later today, we have big earnings from Apple. Well, possibly big earnings, but we have big companies that are going to be announcing this week. Generally speaking, though, the client, I think, is nervous. I don't think there's this real great excitement to really pile into the market right now. That's what I'm hearing right now.
Yeah, you know, I think one, you're having a conversation with the clients, you know, great returns in 2019. And I think in 2019, all of us at this table and all across the country, maybe across the globe, we're talking about, hey, a recession is a natural part of a business cycle. So I think we're kind of gearing up, maybe talking ourselves into a recession, and then we had just an outstanding year. So when I'm talking to clients, we're looking at their financial plan saying, well, we didn't need in 18 a 25% return. You know, we're really trying to shoot for something much less. The portfolios overall are out of balance. We've had large cap growth, or even value, which is really dominated. So we're looking at, we need to rebalance our portfolio and probably move more into our fixed income for safety. So rebalancing portfolios are the conversations that we're having. Setting the expectations at a reasonable level is, what conversations. Okay, we can't expect this to continue, even though we hope it does. Before the coronavirus hit yesterday, or really hit the market hard, I think most of my clients, and I like to talk to the entrepreneurs and our privately held businesses, they have a different type of perspective, and I think it's healthy. I learn as much as I teach, and I think what I'm hearing is that they think 2020 is going to be good until the emotion of the election kicks in. So I think people are looking at that June, July period like, okay, we're going to have some volatility at that point. No one really knows what's going to happen after that, but that was the general consensus before the coronavirus. We'll see, what happens here and how China and the world handle that.
Yeah, exactly. I mean, you look at the returns that we had last year and the planning that we do with clients, the financial planning. Their clients' plans are now ahead of schedule a bit after a year like last year. And so I think the discussions that I'm hearing and feeling with clients is it isn't an overly bullish feeling. It's almost like looking for what is the triggering event that causes the correction or the bubble if there is one. So that's the sense that I'm getting. It's very cautious yet going forward. I feel like a broken record, and that as long as we've been doing these videos, we've been talking about cautiously optimistic going forward. And I think that's still how we feel going into 2020. All right, so let's actually jump into some of the slides that we have today. Let's start, Darren, with the growth of the economy. So GDP and what are we seeing from that perspective?
Yeah, well, on the slide, it's actually shown third quarter GDP, and as the time the slides came out till now, third quarter was at 2.1%. GDP is gross domestic product, and what that means is just the growth of our country. It would be great if we could hit that 3% mark. Our historical average is right around 3% or so. Since this expansion, we've been hovering around 2.2%. The fourth quarter reading was actually right at 2%. Going forward, 2020, a lot of the prognosticators are really saying right around that 2%. There's nothing that is showing us right now that we should be any, we had the tax law change in 2017, which gave us a real spike in 18, towards the end of 18, but nothing like that we'll see. So it looks like right now kind of business as usual. On the right side of that chart, what's interesting is the consumer is very strong right now, and they're the driver of what's going on in the market. Investment ex housing is a little weaker, but I think this is going to muddle through even 2020. I don't foresee a real recession this year. Back to your point earlier, Brad, too, I look at recessions. There's always going to be shocks to the system. Yesterday we saw one, 9/11 we saw one. Those are not recessionary. Those are hard shocks to the system that typically rebound like a rubber band, either within a month or 4 months or something like that. Yeah. Those are not recessions. Recessions typically average about 1.3 years, something like that. And bubbles will create more of a recession, like the housing bubble, like the tech bubble, those types of things. So I don't foresee that. Of course, I don't have a crystal ball either. So
yeah, I mean, and you had a point that we're seeing housing as a whole start to decline, but I think that's global housing, not in the U.S., but Australia could be the fires there, and other countries. I don't know if that will trickle into the U.S., but if you run through the positives, the consumer spending is up, the negatives, manufacturing flat, labor still a big issue in terms of low unemployment, finding qualified labor. Those are things that could push us into a slowdown.
Yeah. Yep, absolutely.
Yep, exactly. And speaking of employment, so next slide actually shows. Look at the fall of unemployment over the last several years, and now we're seeing wage growth as well. So those two items or factors are coming together.
I think Andrew stole my slides ahead of time.
I think he set that. I thought he set that up for you perfectly. Yeah.
Well, what I think is interesting is wage growth. we're seeing a spike, especially like in December, we saw 3.7% wage growth. So we're seeing that come up. What does that do? It hurts bottom lines, typically of companies. So there we maybe see some sort of quote unquote earnings recession. And then it's also obviously really hard for companies to find workers, and, I don't want to talk political. I say this every time, by the way, but, this gets into an immigration issue and the growth of our country. People aren't having as many kids. There's a whole lot of demographic kind of issues going on too.
But the wage growth also is an interesting conversation in terms of, is it because we've had minimum wage increases, in a lot of states at the federal, I think at the federal level also, or is it supply demand? I don't know what the answer is, but that's a conversation that I hear happening quite often.
Yeah, it's maybe a little bit of both, but I feel like it's a supply and demand issue right now. I mean, that's the challenge that companies have, is finding workers and retaining workers as well. And so I think we'll continue to see that going forward. I think it'll continue to put pressure on wages as well.
Right. One thing I want to talk about with this chart, so you see unemployment and wage growth touch like right before the recession of 2001 and the recession of 2008. You see them touch and then they separate, right? And we're seeing them touch again. What's also interesting, when they touch, it can go on for 2 or 3 years. So if you're a trend person or a technical analyst, you look at this and say, it's really interesting, right?
Yeah.
Maybe we have another year or so.
Could be an indicator.
It could be an indicator,
Yeah.
right?
Yeah. Okay. Well, along those lines, I mean, one thing that we do watch is, as it relates to GDP, the growth of the economy, if it's overheating, you look at wage pressure going up, that naturally leads to a conversation about inflation. But we're not really seeing much pressure or growth in inflation right now.
Yeah, this chart kind of bores me because we never have anything new to really report.
Right. It's just more of the same.
Yeah, but the Fed looks at the lower right, that PCE indicator, which is a chain-weighted grouping of products that can rotate, and that's at about 1.6%. The Fed's target is 2%. So, and maybe the Fed is doing an incredible job, which I think they're quite frankly doing a pretty decent job, just trying to manage this whole economy. And I always, when you talk about unemployment and inflation, the Fed is mandated by those two things to monitor and try to control as best they can unemployment and inflation. And here we are, when people complain about how bad the economy is, I sit there and say it's not, right? Inflation's low, unemployment's low. What else do we really want out of this, right?
Yeah, exactly. Andrew, anything to add?
Well, I mean, I think the inflation part and managing our clients' fixed income portfolios, the bonds, money markets are yielding almost what a bond is. But when you look at inflation, you subtract with the yields that we're getting in our fixed income, you actually have, that's the challenge. But inflation, is low. I can't imagine many people are saying the economy is bad, but maybe that's a political perspective. So.
And back to our conversation earlier about the returns last year, one thing that we look at, especially when we're building financial plans for clients, is forecasted return, forecasted inflation. The difference between the two is real rate of return. Low inflation, high growth in equities. I mean, the real rate of return was pretty phenomenal last year.
Right. Yep.
All right.
The other thing I just wanted to touch on too, with inflation at that 1.6 number, and we talked about wage growth, there could be pressure on, it's called wage inflation, right? So, and a lot of professionals are saying inflation could be up. That PCE indicator could be pushing right around 2% by year end. So I'm not just saying, hey, it's all rosy and all that, because as wages do continue to move up, then you have kind of a wage inflation.
That's
too.
Back to the cautiously optimistic mantra that we've been saying for quite some time.
Yep.
So earlier you mentioned manufacturing. That's one of the things that maybe isn't quite as optimistic right now. So what are we seeing as far as manufacturing?
Yeah, all in all, this chart actually shows a lot of green, yellow, and red. Green is anything really over 50. The higher you get over 50, the more green it gets, and same with under 50. with red. Yellow is right at that 50, 49 and some digits, up to 50 and some digits. But you can see Europe right now is turning red. And why is that? It's tariff talk, right? We've been talking tariff talk, I think, for a good year, maybe a year and a quarter with China. Well, now that we have a deal done with China, supposedly the focus now is Europe and what's going to happen to certain European countries. Businesses do not like uncertainty. There seems to be uncertainty now in Europe. And so we're seeing, I mean, this is painting a picture for us that, especially the European countries and Japan too, where we're seeing some red, pinkish digits up there. So.
Okay. How about, I mean, you work with many manufacturing clients, or
Well, I mean,
mostly service professionals? But
it was, in September we started seeing like when we talk about inventories at the largest level, Ford, GM, I mean, so they have inventories of cars, so a good time to maybe go out and buy a new car if that's what you're looking for.
Did you do that? Did you buy a car?
No. I talked to my dad, who thought they were on sale. I talked him off the ledge. But most of the clients that I work with are going to be, and Eide Bailey for the most part are privately held businesses, and those are lagging. I don't think we've seen manufacturing with our privately held businesses. They're still steaming along. Things look good. Now it could be that they're lagging. So I think we're feeling good about what we're seeing with our clients. Time will tell.
Yep, exactly. All right, so the Fed, how do you think the Fed is doing? What's your take on the Fed and the job they've been doing?
Well, it's a bit of a, it's a reality show. Trump tweeting, Fed reacting. I think, I don't know if it's someone like me could even, you have an opinion, but everyone has an opinion on that. I think the economy looks good. It'll be interesting to see, do we ease again? I mean, which has helped the returns on our bonds, or do we stay steady? And I think that the thought is, I'd be curious about your guys' opinion here, that we're going to stay steady and see what happens. But that could change if, like what we saw in the last couple of days with the coronavirus, and if that starts affecting markets and the economy, you could see then more pressure on the Fed to ease and lower rates again.
Yeah. So Darren, what's the chart showing us? I mean, the expectation of what the Fed's forecasting versus what the market's thinking.
Yeah, I don't think they're going to do anything. Actually, 2020, I think we're in an election year. There's a lot of political pressure, or has been, especially over the last 12, 15 months probably. I think they're going to stay where they're at. I think they're going to watch this election. Unless we see some signs of a recession, then maybe they'll act, or they'll have to act. They rotate 4 presidents every year. The ones that rotated out were maybe a little dovish, and the ones coming in maybe a little bit more hawkish. Out of I think it's 16 or 17 presidents, only 12 get to vote. So that plays a little bit in part. But we've had 3 cuts in 2019. I don't think that anything's really going to change. I think they're going to just play this out, unless something, like I said, unless there's some sort of bubble that's lurking out there.
It almost seems like something extreme has to happen in order for them to do something. Otherwise, if they do make a move either way, with rates up or down, it'll become political.
Right.
Exactly.
Mm-hmm.
So I agree that probably just steady going forward unless something extreme takes place. Yeah. What's the market anticipating?
Yeah. So the futures market, which is not the Fed governors, but the futures market is showing a potential another rate cut. But the Fed governors are basically flat, and you see that in the blue, and the brownish is actually the futures and what they're saying. So,
okay. Interest rates around inflation, the Fed, all kind of works together. Rates came down last year as the Fed cut rates. So, any thoughts on interest rates?
Just kind of similar what we talked about the bond market, and again, I use the 10-year, and this is the slide you're seeing right here. The 10-year Treasury started in 2019 at about 2.6%, ended the year at 1.8%. And if you think about that, prices move up, but yields move down. And so when prices move up, obviously there's price appreciation. My take, we've had a lot of discussions. We've had our investment committee meeting yesterday here. Andrew and I have had a lot of conversations about where this goes from here. I've said this, Brad, you've heard me on record for 10 years. I have no idea. The good news is I'm with like 90% of all the strategists and economists, where we try to make a prediction on January 1 and we're typically wrong. Especially the easy prediction is, well, they got to go higher. They don't have to do anything. And especially when you see worldwide yields, what's going on in Germany and France and of course Japan, has been in decades of this. So it is what it is. You take what you can get, and it's kind of ho-hum too.
I mean, low rates are good if you're borrowing money, right?
Mm-hmm.
But if you're trying to generate income for clients, that's our challenge, right?
I think the fixed, we talked about that. The fixed income portion of what we're doing, of how we manage that portion of the portfolio is a challenge. So you're looking at global bonds and other alternatives without taking too much risk, just like we talked about yesterday in the investment committee meeting. But to your point on the housing market, and we look at global housing slowing down, but you look at interest rates overall. I mean, on your very first home, what was your mortgage rate?
Oh boy, that's a long time ago, Andrew.
It was like yesterday, right?
Yeah, it's just like yesterday. Yeah, much higher than the rates are today.
I bet you it was north of 6 or 7%.
It probably was
right?
north of 6 for sure.
So my daughter's buying a home, and or in the process, and it's like a 3.6% rate. I mean, unbelievably low. So so that to me, at least, when you look at that, you think, boy, is housing going to have much of a slowdown? Certainly, those houses and the starter houses, I don't think so, but maybe.
I was reading an article recently about, I think with the millennial generation, they haven't been as prone to go out and buy the first home. Because they're kind of living various experiences right now, but that's starting to trend a different way now. They're starting to buy homes. That's really probably the next growth wave, is the millennial group starting to buy their first homes, like your daughter and my kids as well. And I think it'll be interesting to see how that plays out.
And then the other side of that is the boomers retiring and downsizing. Yeah. So, what happens with those houses, because those are, your high-end homes.
Yeah, exactly.
So you've got different challenges there.
Yeah, so speaking of the past, you guys remember the tech bubble?
I do, yeah.
Yeah,
Yep.
You don't remember? You're too young.
It's when Amazon was a bookstore.
That's right. So tech bubble. What were valuations back at that time, as we were in the late 90s hitting 2000? What were valuations roughly? Do you remember?
Probably about
multiples?
24 times earnings.
24 times
like
earnings.
Yep.
So let's talk about where valuation is now in the market. S&P 500, a little overvalued, but certainly nothing like we saw back in 1999.
Right, and right now we're just north of 18, as you can see on the chart. Through yesterday, I just looked at, we're actually a little 18.6 prior to yesterday's big pullback too. So it's probably dropped back to that 18.18 or something like that. 10 years ago, coming out of our housing bubble, we were at 13.95, 14, right around there. So PEs ebb and flow. It's a great indicator, and I always try to define that's P divided by E, numerator, denominator. When the E is good, earnings, the P should stay in some sort of relation. Are we a little frothy? There are certain people out there that say we are. I look at this, and what's great about the dotted lines is you're within one standard deviation and not even really overly close to the top side of the standard deviation. We've seen them here before. We've seen a pullback last December of 2018, and the market kept chugging on. So,
yeah, I think it's a good conversation to have in terms of, is the U.S. a little expensive? Is it overpriced? And we've been saying that for a while. And then you look at, well, where's the value? And that points to international and emerging markets. Should we be? We need to rebalance our portfolios anyways, because the growth and equity side, but should you be looking at a tilt to an international and emerging markets? I think those are good conversations to have. I wish I had an answer on that, but the international and emerging markets are a better value at the moment.
Right, exactly. Yeah, so we're in the early stage of fourth quarter earnings being reported for the end of last year, and what's been happening, right? Earnings have been strong, to your point, and propelling then prices to continue to go up. So, I mean, if you look at the chart, we're a little overvalued. If we come back to historical average, either prices have to come down or earnings have to go up. So it'll be interesting to see what happens. But so far, indications look pretty good that earnings will keep climbing. So, last year, especially fourth quarter, kind of opposite of the year before. Just, you wake up every day, the market just goes up. Wake up the next day, Groundhog Day, right? You just wake up, market keeps going up and up and up. And this next chart talks a little bit about kind of historical ups and downs of the market, what we can see year in and year out. What is this telling us?
Yeah, so basically the bars on the chart are how the year ended. So the S&P 500. So as we can see, it showed basically last year we were up 29%. What people don't understand is there's all kinds of volatility in the market. And on average, you're going to see from peak to trough, anytime in between January and December, an average of about 13.8, 13.9% decline. So we're going to see volatility in the market. I mean, it's just a natural part of investing. Like we talked about earlier, we saw a 450-point drop yesterday in the Dow. It's very natural. Last year, like you said, it was almost Groundhog's Day, but we did see a 7% drop within the year, but the market still ended up 29%. So point being to this slide is we're going to see volatility. We need to see volatility, quite frankly. Otherwise, if it's too easy, it's not really real. So, it's kind of like last year too. I mean, hey, we got a 30% return. Don't expect that. Like I said in my opening comments, it's not going to happen for 10 years, even though we'd all love it. But anyway, so volatility is.
Yeah, and we're in an election year, and volatility is pretty common in an election year. So I think, as you talk to clients and we create expectations for ourselves as investment advisors, that I agree with what you're saying. It's going to be my guess would be a volatile year.
So, Andrew, thoughts on kind of switching gears a little bit, but you mentioned international markets earlier being a good buy. In a diversified portfolio, I mean, what do you think the mix should be, a U.S. to international?
Well, I think most portfolios have had a growth in U.S. equities, especially large cap growth, even large cap value and core. So it just depends on the client and having a conversation in terms of their bias towards a home bias in terms of what they think should be here in the U.S. But when we talk to the academics and they look at a good portfolio design, they're saying in the equity portion of your portfolio, 2/3 U.S. and then 1/3 international and emerging markets, or some mix like that. And the reality is there's not a right or wrong answer on that. We want to be diversified. That's what the only free lunch that we get in investment advising. But I think it's a conversation with the client and the comfort level with the client and the investment advisor.
Yeah, exactly. I mean, as you were saying earlier, value international is a good value right now. I mean, this chart kind of shows the growth, the valuation of the U.S. market versus international, and you can see the divergence there. It's pretty remarkable, actually.
Yeah, and we're at 14.2 times PE, which is 78% of the current U.S. PE through year end, and it's 80% of their average. So, we talk about valuations, undervalued, overvalued. U.S. is slightly overvalued. International is slightly undervalued. So if you're a Warren Buffett type and you are a value investor, this is on sale. It's hard, right? Because we're looking at this chart and it's flatlined basically from what is that, 97 on. And so it's hard to put a third of your equity portion into that. What I think is interesting, if you look at the worldwide market cap, U.S., for years and years, it was 52, 53%. With the market growing and our tech stocks especially growing, the U.S. owns about 56% of that market, which is that a bubble, right? Anything out of the norm, does that tell us something that something has to revert back to the mean? Maybe it's international.
Yeah, exactly.
Well, we had 2000 to 2010, which was the last period that international outperformed the U.S. That wasn't that long ago.
It wasn't. The lost decade, right? I mean, go back 2000, to 2010. The S&P was flat for 10 years. Your growth came from international stocks. Like you said, it's funny how quickly we forget, right? All right, so this last chart that we have, this one, I mean, not that I'm a chart person, but you probably are more than I am. But this to me is fascinating when you look at this chart. And it does indicate that there still could be room for growth going forward. The bull market could continue.
Yeah, and so I've shown this, I think, the last year or so, and I'm really intrigued by this. And the whole point is, if you are a long-term investor, and we have a lot of younger employees within Eide Bailly, you cannot afford to miss out on a 10-year breakout. And this is what's called a breakout in the charting, the technical analyst world. What's also interesting, the vertical darkened bars are recessions. So if you go back to 82 to 2000 and you see 2 or 3 recessions within that 18-year period, it's going to happen, but it's still in a sense a bull market that can keep moving up. So if you're a chartist, and there are people, I say this all the time, that's all they do. They don't care what company they're looking at or what index they're looking at. All they do is read charts. This would be a breakout pattern for somebody like that. So I think it's just good to, there's a lot of negative things out there right now. This I think is something to at least think about. And we've only had really 2 other real bull markets like this since 1900, and it'd be great if we had another one. But
well, and investing, it's a long game. Stay disciplined. I mean, generally, when you look at investing, what we're trying to do is prevent clients from making bad decisions. I mean, there's usually 4 to 5 days in a market over a 12-month period where you really make money. I mean, that may have been different in 19, like you said. Every morning was all-time high. But you want to have a diversified portfolio. You want to stick with that portfolio and have discipline and look at this on a 5-10 year basis. And if we do that, history shows we're going to make money.
Speaking of that, this last slide actually shows that. So again, you did set him up very well, or took his slides. I'm not sure which one it is, but either way, it set it up very well. So we always end with this slide.
the 6 hours of prep we did on this,
Well, yeah.
I think, has really come to fruition.
Exactly.
So, but keep in mind,
Minutes?
Yeah,
Right.
days.
Days, yes.
There's all kinds of risks in the market right now. Obviously, we're in the middle of or soon to be in the middle of an election. We have volatility, which we saw yesterday, coronavirus, Middle East conflict, valuations, some people will say, are a little maybe high in the U.S. Market. But when you look at this, we call it the quilt, and on the top is the best performing asset class, on the bottom the worst from year to year. The whole point of this is the line and the white box. It's, hey, a diversified portfolio. Most people can live with a 6% return, and you're lessening your volatility, the swings in your portfolio, just by having a properly allocated portfolio. We talk a lot about the economy and Europe being better, or international being better than the U.S., but at the end of the day, this is always what wins.
Should own all of it.
You got to own some of all of it,
Yeah.
and then it's up to your financial advisor to get you right into the right spots.
Yeah.
So,
Yeah,
Andrew,
exactly.
anything to add on that?
No, exactly what I was just saying.
Yeah, and diversification and diversified portfolio is part of the financial planning that we do, right? So we chart kind of a forecast for the client, and then build a portfolio to make that happen over the long term. Another item that recently took place that's impacting our financial planning is the Secure Act that was passed in December. So just general high-level thoughts on that and some of the impact it will have to our planning as we go forward.
Yeah, well, I mean, 2 big takeaways. And, as a CPA, we're looking back to 2019, so I've got to get my mind thinking to 2020. These are 2020 issues. You no longer, we don't have caps on funding IRAs, so you can be 70 and a half and continue funding IRAs. There is a little bit of a catch to that, so you want to work with your CPA in terms of if you're going to fund deductible IRAs, and then the change in terms of inherited IRAs, in terms of how the folks that inherit those, how quickly or slowly they can take the distributions. So those are the big points that we want to look at.
And the RMD age too.
Oh,
moving up to
thank you.
72.
Yeah.
Yeah, 72, yeah.
Yeah.
Which would be,
Right.
we have a lot of clients that don't want that RMD
Right.
and they want to push that off. So
Which goes to your point of Roth conversions may be
Possibly.
there
Yep.
for another year if we have, before we start those RMDs and we don't have much in the way of income.
Yeah, our software does a nice job of modeling the Roth conversion strategy and just showing the long-term impact that has to a client in passing assets on to the next generation. So it's a nice modeling tool to kind of demonstrate the impact of that.
And they did change the rules on Roths, which I don't think really surprised us, but no
It's too
longer,
good to be
no
true.
longer do we have a
Yeah.
forever tax-free annuity. It's a 10-year tax-free annuity.
Exactly.
So.
All right, sounds good. Well, hey guys, thanks for your thoughts and insight. And Andrew, thank you for joining us. We're going to take a quick break and then we'll be joined by another guest. Well, welcome back. Joining me now is Chad Flanagan, partner in charge of our Fargo office and also partner in charge of valuation. We've got a lot of titles, a lot of hats.
I do.
So thanks for joining us. We just want to spend the last few minutes just kind of talking a little bit about some of the things happening within Eide Bailly. And I want to start with first as partner in charge of an office, just kind of general thoughts on how the year has been going. And now that we head into busy season to kind of finish up the fiscal year, just how are things going and what are you seeing as opportunities?
Yeah, having a great year so far in the Fargo office. I think they've done, our partners and managers have done a really good job embracing Salesforce. Also, one of the challenges we have, which I think a lot of our offices have, is just having enough people to keep up with the growth.
Yeah.
And so I think our team has done a really good job, including specialty services, including NTO, some of those resources where we can identify those opportunities and bring other specialists in to help with those projects.
Yeah, so, we were talking earlier when we were going through the market commentary about unemployment coming down drastically over the last several years and how wages have gone up because of supply and demand. And I know we're feeling it as well as a firm, right? Trying to find quality employees and then retaining those employees. What are some of the challenges that you've seen there?
Yeah, we have to remember that we have a lot of bench strength, and that's one of the benefits of being a national firm, is that we can draw in that talent. Our people out in the field talking to clients can be that relationship manager, identify those opportunities, and then bring in those resources, including wealth planning.
Yeah. So how, speaking of wealth planning, something that's near and dear to my heart, how do you go about in Fargo integrating the wealth planning services into other aspects and services of the office?
We're fortunate in Fargo to have representatives from all three teams. So we have financial services, business valuation, and WTS.
Yeah.
And so we'll get together at least every 3 weeks. We'll talk about opportunities we're seeing in the marketplace, technical updates, and really just try to network together and go to market as one team.
Yeah.
That includes getting in front of our tax group at least once a month and talking through opportunities and questions to ask and those kind of things.
So when you get in front of the tax group, talk a little bit about what does that look like? I mean, how do you guys prepare for that? And then when you're in front of the tax group, what is it that you're doing?
Yeah, the last one we did, and again, this is all right ahead of busy season, so we got in front of the tax group and talked through 10 questions to ask clients. And these questions come from financial services, valuation, and the whole group collectively. So we talked about buy-sell agreements, we talked about growth expectations, exit planning, all of the things that we think start great conversations.
Yeah, and then, so that's internally coming together and proactively connecting with folks inside of the office, but also you do things externally as well as a wealth planning team. What are some of those things?
Yeah, we find opportunities to network with attorneys, banks, trust companies, those type of people that typically, we can team up with them to better serve clients in our community.
Yeah, yeah. So let's go to the other hat that you wear in running our valuation team. So what's going on in the world of valuation? What did you see in 2019? What do you anticipate for 2020 as far as activities and opportunities in the valuation space?
Yeah, we had a good 2019. Really got into working with our ESOP team and seeing a lot of opportunity to help clients evaluate whether an ESOP makes sense for them, do feasibility studies, negotiate with the trustees or the banks. And it represents a large opportunity for our group and some of the rest of the groups that we have working in the firm on that. We think 2020 is going to be an interesting year. It's an election year, and just some of the uncertainty around if there could be changes to estate planning, would that trigger accelerate some planning, and would that generate demand for business valuation? So we're ramping up.
You're saying there will be interest in the upcoming election, and it could have an impact on planning going forward.
Yeah, and
just a kind of a wild guess, maybe.
Just a guess. We think about anytime the exemption rate changes, the valuations for estate planning can we've seen it before, where there's a sudden demand for those services. And things like the wealth tax or a lot of questions around that, but would that trigger a lot of need for business valuation?
Yeah. So I know one of the things we're working on right now, and within Eide Bailey Financial Services, we recently brought on board an insurance specialist that I think is going to really allow us to really focus on and grow our insurance services as we go forward, and having that in-house expertise. And I know you're partnering with Zach, who's the person that joined our team, to really kind of launch an initiative here in the near future. Talk a little bit about what that is and what that will look like.
Yeah, working with Zach, the valuation team, I think recognize that there's an opportunity to have really good conversations with clients about exit planning. And one of the tools that can help with exit planning is a good buy-sell agreement. Yeah. So many of our clients may not have one, and we encourage them to work with an attorney, work with our team to develop one, as well as just let's review the one they have in place. And it may have been a few years since they've last looked at it. Yeah. So we want to make sure it includes the proper trigger events, that it has good valuation mechanics in it, as well as funding for potential death.
Yeah, so we'll review the buy-sell document. We'll look at valuation metrics. We'll look at funding. We'll do all of that. That I think will be a great service for us to be providing to our clients. So more to come on that. I know we're preparing materials around that. We'll be rolling that out in the near future.
Yeah, we think again that not only can we kind of check that box for this buy-sell agreement, it's a larger conversation. It's about exit planning. Do you have the right leadership management in place as you potentially exit your business? Have you done the proper estate planning, the wealth planning? Retirement is always a sensitive subject, but it's an important one. And us as trusted business advisors can have those with our clients and push them a little bit because it's important.
Yeah, I'm looking forward to that. I just think it's going to be something that will be an easy introduction for our CPAs to bring to clients. It'll be a value add for sure. And a lot of times those buy-sell documents, like you said, they get done early on in the business. The business owners focus on growing their company. That document gets set aside. It hasn't been reviewed in a long time. It probably needs to be. And the best time to do that is before a triggering event happens rather than after the fact.
And we know this because we've been brought in after a triggering event, and sometimes it goes to litigation, and there's a lot of conflict and fighting. A lot of things can be figured out ahead. And like you said, I mean, we want to make sure those buy-sell agreements have good valuation mechanics. We've seen some that have a stipulated value in them but haven't been updated for 10 years. We've seen some that have valuation formulas that are not even close to what they should be, and so we want to help before a triggering event occurs.
Well, and on the insurance front too, looking at is there enough coverages in place? as the valuation grows and the business becomes larger, maybe the funding vehicles aren't there to support what the valuation number is, whether it's death or disability or something else
Right.
as well. And our new guy Zach, he's he kind of wants to make sure that I'm doing everything the right way in communicating this initiative. He's standing behind camera right now, making sure that I say the right things here. So hopefully I get the thumbs up when this is done. So Chad, thanks for joining us, and appreciate everything that you do. And I know we've worked together a lot. We've traveled together a lot. It's been fun really getting out and helping our clients. And so look forward to doing more of that in the future.
Thanks, Brad.
All right, sounds good. Well, thank you for joining us for our quarterly update, and we'll see you next time.